I'm Kyle Guidry, and today we're going to be doing financial analysis for Dr. Cresson's Finance 381 class of fall 2015. A criteria for the analysis. We're going to be doing a short-term loan for 6 months, a long-term loan for 5 years, and we're going to also be purchasing 50% of the equity in one of these companies. Our 3 companies that we're undergoing analysis are Eli Lilly and Co, Zoetis Inc, and Hornbeck Offshore Services. First one, Eli Lilly and Company. Founded in 1876, they're based out of Indianapolis, Indiana, and they're a global provider of pharmaceuticals. Our second company is Zoetis Inc. They were founded in 1952, based out of Florham Park, New Jersey, and they're the world's leading provider in veterinary pharmaceuticals. Our next and final candidate is Hornbeck Offshore Services Inc. They were founded in 1980, and they're based out of New Orleans, Louisiana. They're a provider of marine transportation services. First ratio we're going to undergo for liquidity for short-term 6-month loan is our current ratio. Now, our current ratio is assets over liabilities. So basically, we're just going to see how well these companies can pay off their short-term debt. We want this ratio to be high, but not too high, because it shows inefficiencies with cash. So here today we have Hornbeck, who started off in 2010 at 4, jumped up to 7, back down in 2012 to 2, back up in 2013 to 6, and then settling at 4.5 in 2014. It's not a bad ratio. The problem is we have inconsistencies. We're going back and forth all over the map, and it doesn't show that you're stable. It gives the idea that the company, we're not fully sure where the future is going. And then we have Lilly, who starts off with a little ratio over 2, maintains steady, but unfortunately it is a steady decline. And while they're still maintaining right at 1, you want that ratio higher, or at least see that it's growing in a positive way. Which then brings me to Zoetis, who starts off just under 3, maintains that, but even you see there was definitely improved growth from 2013 to 14 right there, which is exactly what we want to see. So right now, my leading candidate for the 6-month loan will probably be Zoetis. Next, we have our quick ratio, which is going to be assets subtracting inventory over liabilities. This is to kind of see our cash, securities, and receivables. And sorry, my apologies. Again, we see Hornbeck all over the map here. Not exactly something we want to see. It just it shows inconsistency. And in markets today, we are looking for consistency and growth, which again, Lilly, while we have consistency, we also have consistently declining. And Zoetis here, starting off at 1, they are in fact moving up though. So that's good. Another, I should say, point in the back of Zoetis. And then we have our cash ratio. The cash ratio is the company's cash over liabilities. So this is going to be to see, cash and assets to cover the debt. And we're looking again, Hornbeck everywhere. Inconsistent. Lilly, consistent but consistently declining. And we have Zoetis. Starting off, because then now give a brief history of Zoetis here. Zoetis did branch off of their parent company Pfizer back in 2009 or 2010, right in there. So they didn't start off, very high, but they're a new company, growing, and we like to see where this is going to head. Which then brings us here. The recipient of the 6-month loan is going to be Zoetis. The company showed the most consistency throughout our liquidity ratios, and in addition, they also showed us some promising growth, which is really, really nice to see from this young company. Next, we're going to be moving on. Now, we're going to be looking at the 5-year loan. And for 5-year loan, we're going to start off with times interest earned. This is going to see how well can the company cover their debt with what they have on hand. We're going to see here, Lilly, fantastic in 2010. Covered their debts over 35, 36 times. That's fantastic. Then we see them drop down in 2012 to, let's see, where is that? Right around 27. Still great, back up again to nearly 40 in 2013. And we took another dip here, and we're going to rest at 20 in 2014, which is still fantastic. Hornbeck, We started off kind of small. We did maintain consistency, which is something I like to see, but unfortunately we didn't get above, we never even hit 5. So it doesn't show us that that they can cover their debts that well. And Zoetis started off low, like we said, when they started off as their own company, but then moved up and were able to cover it 20-fold in 2012. And they fell back down, so now they're right around 8 in 2014, which is still good, but right now I think Lilly is currently the leading candidate for the 5-year loan. Which then brings us to the equity multiplier. This is to show us how much risk they're taking and how well they can manage that. So right now, who's financing with debt or who's financing with equity? So we see here, I'm just going to start off with Zoetis, starting off with nothing, but as you move up this line, we're starting to see that they are financing more of their assets with debt, which, we're looking for people who are able to manage that line a little bit better, bring in some more equity, should have our investors pay for our assets, and then that's really what we're looking for in this case. And we see some nice consistency here. Lilly maintaining good balance, Hornbeck balance all throughout. But I think because of how well they can cover their debt, the 5-year loan is ultimately going to have to go to Lilly. They were the company with the best position to pay. They were in the best position of the 3 to pay back the long-term debt. Even when they were taking the most risk, the company could pay it back 35-fold at that time. Which then brings us now. We are now purchasing 50% equity in one of these companies. So the way we're looking here, young company Zoetis, starting off 2010, they're taking a lot of risk, but I like where they're going. They showed us growth when we were looking at liquidity ratios, and that's really, really nice. Because these other two companies, while they're older, they are showing more stability overall, and we like that. We want to see that in these markets today. But we're going to move along here. We're going to see the return on equity. How much of their net income is actually going to their stockholders is what we're going to see here. So in 2010, Lilly was at the highest, at just under 50 here. And they declined, plateaued off again, but then declined in the last year here between 2013 and 2014. Hornbeck started off, kind of low, but then we actually dip into the negatives here. I don't know if you can see that on the screen. They're in the negative in 2011. That is bad. We do not want to be taking equity away from our stockholders. They did recover nicely back in 2013, head up back to 10, but who can pass up here? Zoetis, starting at nothing and then just building. And then the skyrocket here from 2013 to 2014, from 20 to over 50. Zoetis is really giving their stockholders some equity here. Profit margin. Now, starting off, our values, when you look here, the values aren't that high. However, Zoetis did have a big boom between 2010 and 2012. 2011, wow, fantastic year. Lilly, we started off, we stayed steady, then we took a dip in 2013, so we didn't clear as much of our we didn't clear as much profit after our costs, but they're still looking good. Hornbeck dips down here into the negative. So it really makes me think something must have happened in 2011, because we've seen this all up to this point. In 2011, they've shown a major dip, and I'm guessing it's going to be coming up here soon, because this is not exactly what we want to see here. So Zoetis maintained steady. Hornbeck did recover in 2013, kind of back up there, but we're going to move along. Which then brings us to total asset turnover. Who is maintaining their assets the best? So right now, Lilly started off very, very well. Maintained kind of steady here, but we did take a dip. And then over the last year, 2013, 2014, we saw a significant drop. Zoetis, what can you say? Fantastic new company. Boom. really, really, really moving their inventory out and maintaining that level very well. Hornbeck maintained steady, but they would still fall behind Lilly in my point. Right now, I'd say for our purchasing of equity, we're really starting to look at Zoetis here. Which then brings us to return on assets. This is going to be our asset efficiency in dollars. So basically, we have, again, you see, Hornbeck starting off good, taking a dip in 2011. That must have been a really killer year for them. And back up, we did see good growth in 2013, but we plateaued back off again in 14 with even a little decrease. Lilly starting off very high, decreased here between 2010 and 2012, and we showed another increase between 2012 and 13, but then ultimately falling back down in 2014. Zoetis here, starting off in 2010 and showing good growth here. And while we're starting to plateau there, we are still maintaining a level of growth, which is very nice to see, especially when you're becoming more efficient with those assets. So they were turning them over really well before. They're still turning them over, but they're making more from them now. Which, price to earnings. This is going to say it all when it comes to who has the most chance for growth. What are they giving, stockholders? How are we looking here? And here's where we see it. Our price to earnings really, really, really did not do well for Hornbeck here in 2011 at negative 350. Wow. So they did recover, but they just took a major hit there. Lilly maintained steady, did show growth, but Zoetis, to come out of nowhere and just continue to blow away the competition the way they are. They're showing great potential for growth. They're managing their assets very well. Now, they didn't qualify, the 5-year loan did not work well for them because of the issue with they're taking on too much risk. But to see the growth that they have long term, well, the short term here, I believe that this company is probably going to be the best to invest in. They've shown consistent growth, and that's what we want to see. So for Zoetis, this company has shown to be very promising in terms of consistency and growth. I can't say enough about them. They have a fantastic product, and really, really, there's a good chance we can make some money here. I also want to give a special thanks to our Bloomberg terminals at Southeastern, Google image searches, and Wikipedia. And thank you to Dr. Cresson. It's been a great semester.